And for a little more investment analysis on the results season, I'm joined by fund manager Roger Montgomery. Roger, welcome back.
Thank you, Ticky.
Now, before we go to some results, Tony Abbott's paid parental leave. Everybody's looking to where this extra $1 billion or so is going to come from on the funding side. And there are reports that it could come from investors' franking credits. How might that work?
Well, essentially, the company is being taxed by the amount of the impost.
So that 1.5% levy?
1.5%. So there's a 1.5% additional tax. But by not giving investors the benefit of the franking credits associated with that tax paid, it means that investors don't receive the credit. So effectively, that portion of the dividend is unfranked, and we're back to the double taxation days of dividends.
So it's quite clever in a way. It's quite slick and right. Investors obviously lose out a bit.
It's great structuring. It really is great structuring. But taxes don't typically get repealed in Australia. They only increase. So you wonder what other tricks are going to be brought out to justify further increases in this tax. Yeah. And what we're effectively getting is a clawback of the franking situation in Australia, which is not good for Generation Me.
All right. Right, well, let's go to some results. Now, Coca-Cola Amatil reported today, a little bit disappointing from the market point of view. Should Terry Davis have got out at the top when it was going so well a year or so ago? Well,
look, the problem for Coca-Cola is that, if you look at the share prices of the supermarkets versus Coca-Cola, Coca-Cola's down about 9% for the year, and the supermarkets are up about, Wesfarmers and Woolworths are up about 20-odd% for the year. And I think that's a really important point to begin our conversation, because it reflects the relative power and it reflects what's going on. The 6.4% decline in volumes that Coca-Cola has experienced this year is the worst in more than a decade. And what it reflects a situation where Coles and Woolworths are saying to Coca-Cola, well, look, if you don't lower your prices, we're going to go offshore and get the parallel import, the grey import. And Coca-Cola's quite rightly saying, well, look, we don't want to lower our prices, we want to keep people in Australia employed.
Yeah, so that's what Terry Davis was talking about, wasn't it? Jobs.
And that's what it is. And so the only bright spot for Coca-Cola's result was the mineral water business. Sorry, no, it wasn't actually. Well, the mineral water business did okay, but it was the big increase in profits from Indonesia and PNG. But of course, that's a speck in the ocean in Coca-Cola's results. The rest of it's really tough. SPC is really tough. We've got very cheap imported fruit and vegetables in cans coming from overseas. Nobody really knows how they've fertilised those things. So I'm going to just make a political statement. I'd rather pay more for the Australian product and know that it's healthy.
Will they get their own back, though, on the supermarkets, perhaps? Because they're looking at now distributing beer, aren't they, from Molson?
Well, yes, that's true. But you have a look at where the power is now residing in the distribution of liquor, and there's three tiers in the promotion of in the liquor business. You've got the grower, you've got the wholesaler, and then you've got the retail distributor. And typically, the retail distributor doesn't get much of a margin, but in huge volume. Now, because of that huge volume, they're able to actually push back the margins lower for the wholesaler and the grower. And so, again, they're going to win on this one.
Let's move to some good news in the funds management area.
Yes. Magellan, fantastic result. Profits up over 400% on the back of revenue up about 300%. I know Hamish Douglas and Chris Mackay very well. In fact, I should declare that they own a very small percentage of my business, Magellan Financial Group. But they're on a path to 30 billion, 40 billion, 50 billion under management, and they're able to achieve.
What are they now? Because they're smallish, aren't they?
Well, 16, 17 billion dollars,
yeah.
but well on the way to substantially more under management.
And Challenger too had some pretty good
results.
Challenger's
a difficult business to analyse for a lot of investors, but some smart fund managers have actually bought in at the bottom. And the problem is it looks really cheap on the surface, because the implied valuation of the fund's management business is about a third of what other fund managers are trading on. But Challenger also has this business of deferred lifetime annuities. And if Ken Henry gets his way and we see legislative and tax impediments removed for the sale of those lifetime annuities, then the banks might step in and start competing with Challenger. So I think that's why we see it looks cheap, because of the change in potential competitive landscape.
Oh, okay. And briefly, mining services results coming in, and
yes,
as you've been saying,
we've talked about this
grim
on the program here now for over a year, and Fleetwood was a result that came out, and I thought Fleetwood result was typical of what we're seeing in this area. Reported profits, the headline numbers were down 77%, and the outlook statements aren't very good, and they've cut their final dividend. So it's a lesson for yield chasers as well, because if the dividend's cut, your yield is zero.
You have to pick and choose your mining services company. Roger Montgomery, thank you very much for joining us.
It's a pleasure, Ticky.